Hello, Marin County. Figured I'd make a fun little video today about the mortgage rates and geopolitical uncertainty. I saw this article. Everybody keeps asking, how's Russia going to affect the U.S. market? And honestly, I didn't think it would be a big problem because mostly, uh, Russia's kind of isolated outside of gas and oil prices. We don't have a lot of trade with them. They're actually a relatively small uh, part of the global economy for as large as they are. But their interest in Ukraine is that they're, you know, heavy in everything. They've got a ton of natural resources and potentially a bunch of nuclear resources. Unenriched uranium is substantial there, but big farmland, big you know minerals and metals. So there's all kinds of stuff that they could extract from there that'd be useful. Plus, it's the origin of Russia. So, anyways, as far as the mortgage rates and how things are going to work, I figured it'd be interesting instead of giving my opinion, just to show you things that I would look at as a stock trader or as an investor in forecasting what the Fed's going to do at the FOMC meeting, how interest rates are looking, and basically how mortgage rates and the 10-year Treasury bonds sort of coincide. First, I figured, the article's talking about oil and gas prices are going to surge, saying that the average rate is 3.89 at the weekend of February 24, and it's down 3 basis points. So it went from maybe, basis point will be the decimal point here, 3.5 to 3.8 or 3.8 to 3.5 or whatever would be 3 basis points up or down. So essentially, if they go from, um, FOMC meeting standpoint of we need to curb inflation, they would want to lower it. They'd want to put more credit out there. They would hope to stave off inflation. Oh, I'm sorry, they'd do the opposite. They would want to reserve credit. They would want to shorten the money supply so that people wouldn't have as much money to go and buy things and drive the cost of things up and be wanting to buy things at such a rapid rate that there's a shortage of things. So the 10-year Treasury bond shows kind of an interesting path, since basically June of 21, uh, it has been increasing. So you've got, this huge, let's see here, we got 21. It's way back here, actually. Let me see if I can move myself out of the way there. So in June, we had some of the highest sales volume ever. So as the interest rates were going down, people were buying more because it's the summer, people are moving. Plus, the interest rates are super low. So if you've got, a basis point of 1.2, then whoever's reselling mortgages is going to make a point or two or whatever they're going to make. And so a 2% mortgage was actually pretty common for commercial property and for things like that, and for people with really great credit, and for people that were doing PAL loans against their stock portfolio or whatever. So as the rates started increasing, they got to an all-time high recently for the first time in a long time. We look at the monthly, and you can see the curve was basically, let's move me again. November of 2019 is sort of where this peak tapered off. So we've got, January of 18 down to probably November, maybe in October. But November of 19 was basically the beginning of a strong decline. So we've got August, yeah, right there. You can start to see the, people are trying to invest less and less in the treasury bond as these yields go down. So if you've got $1 trillion, you're not going to be wanting to be parking that $1 trillion in a 10-year treasury bond. The incentives are lower and lower as the rate goes down. So they'll find other things to invest in. On the other hand, the stock market rallied from basically, COVID, which would be the beginning of April, until current. So we've got this huge curl going up. And as the Fed stopped feeding the beast and buying up all these securities, the interest rate started going up to incentivize people to stop spending as much and to fight off inflation, to try and slow the effects of supply chain disruption and all that. Because as the money supply expands, you have more cash to spend, then everyone's buying everything. So If you have a bunch of people buying everything, then there's less of it to be had if supply chain can't keep up with the global credit spend. So then the interesting thing is you get into what they call the 10-year Treasury constant maturity rate, which essentially shows what you're going to get over 10 years without any kind of other calculations involved. And you can see from February, the beginning of February until the middle of February, it was sort of bouncing around, and it looked like it almost was going to come down. Right, this is the 9 and the 24-day moving average, and as they cross over the 24, it's going to go up, and as it comes and crosses over the 24, it's probably going to go down, like you see here. See, this is the moving averages, 24 days and the 9-day moving average. So in the short term, this sort of shows the typical direction of where the trend is happening. So right here, at the end of December, you can see it went on a huge rally. As the beginning of the year turned, everyone was wondering, what's going to happen with housing? Well, as the supply goes down because all the realtors are on vacation, from like November until the end of the year, kids are out of school, no one's moving. It's a tough time, to be around your family and all that. Essentially, you've got put this off. Sorry. You've got essentially, them raising rates, and they're going to go into the quarterly FOMC meetings and decide if they're going to keep increasing rates to try and stave off inflation and all these issues. However, the cost of gasoline from November, if you would have bought Chevron somewhere as the stock market in August started tapering off and everybody was bailing on Google and all the big blue chips, um, oil and gas started going up. So, you're looking at 33, and then now it's up to 98. So, crude oil futures went through the roof pretty early on. And then the Freddie Mac is kind of interesting. This one just fell off a cliff right here in June. The 30-year mortgage rate and all that stuff started really getting competitive. You've got the big housing surge happening, all-time high sales, rates are getting to an all-time low. And then, June is an awesome month. If you got a mortgage rate in June, you did pretty good. However, if you were buying, towards the end of the sales slump, maybe you got a good deal because the rates are still low, but the inventory was, kind of stagnant. It wasn't as strong as it was in the summer. It's a chance to get some money back in. Marin, Nevada would be a good example. People were starting to actually take less than offer. So you list a property and you may not get the ask. You may have to wait a little bit. You may have you won't have a buyer frenzy basically. So it was kind of interesting, as the rates go down. Let's say you go from 3.8 to 2.8, you have a 10% gain in your buying power. If it goes from 3.8 to 4.8, you lose 10%. 2.8 to 3.8 was 10%, and then 3.8 to 4.8 would be another 10%, and so on and so forth. So if it goes up to 5 or 6, if the Fed really wants to stave off inflation and really wants to slow the economy down, to try and buckle up for basically an increase in prices of everything to the point of scarcity, then that's basically what they're gonna have to do. Is they're gonna have to tighten the seatbelt on the credit. And the problem with that is as credit slows down, the economy falters. So it's kind of a double-edged sword. And if we don't have GDP and things like that, we don't have jobs. So it's an interesting place to be. And the money print was, without getting into a huge political discussion, that was hard on the economy for sure. Everyone's sitting at home, they printed a bunch of money, and now, credit's at an all-time high, and default rates are surely going to follow if they start tightening and employment goes down and, things like that happen. But anyway, this is the gasoline futures. You can see they went skyrocketing. Futures are skyrocketing. So Russia didn't have a lot to do with this. It was already pretty much a projected thing, since COVID. So you have here is the decline when everybody was jumping on their IRAs and really panicking because you had this huge sell-off coming from the end of 2019. Like I said, November was kind of the crescendo. I guess December maybe it went up, and then from December, January, it just went a free fall for quite some time. You got December 19 to April, I actually started trading stocks here in November, I think, of 2019. So it's kind of a fun time actually, because I came in here and made a bunch of money towards the end of the year, but then I just kind of watched as the whole economy started to freak out over COVID. And then, I kind of was watching, I guess on my birthday was when it was kind of a tragic day. The 17th of February was my birthday's the 16th of February was kind of a terrible day for the market. My birthday was on the 17th. So then the next day was not great. But either way, you can see the uh, cost of the oil futures. They're definitely on the way up. The cost of Freddie Mac's loans, not necessarily. If you go into let's go into the 15-minute chart, you can kind of see a more localized day by day. This will show about a week. Um, Honestly, the rates were already kind of going down. I guess as we were talking, post the Olympic talks, um, the rates had kind of started falling. And if you get into maybe like a monthly view, the rates were already kind of falling. They had hit a high, and now they're you know lower than they've been in a while, but they're still uh, kind of still higher. But I think that they're going to tighten up again, and they'll fall for a little bit. But when the FOMC meeting happens, likely it's going to go up again. I believe that they're trying to slow the economy down and try and figure out how to cope with the housing prices, because even hedge funds are going out and buying houses. There's an insane amount of wholesale activity where hedge funds are basically using houses like stocks. And rightfully so. If the price is going through the roof and the stock market's going into the toilet, everyone's taking profits. We had 2 years of rally. If you look at anything, I mean, even if you went to the SPY, right? Just the SPY, you can see again, boom, went to the roof. Now it's coming back down. We hit a high of somewhere around 480, 490, something like that. And then had a big pullback, another rally, and now we're in another pullback. So now a lot of people thought it would go over 500 and we'd have the super rally. And I think that's probably what's going to happen, to be honest. But there's a pretty good chance it could hit 252. So it came from, about, I don't know, 250, something like that back in, I don't even remember what it was. Let's see, there's COVID somewhere in here. Had a pretty good rally, and then it essentially, so September 20, and that would be before that. Yeah, there you go. So since the COVID depression, it doubled. So even if it's gone down, 50 points from 450 or 480 to 430, it went from 480 to 430, it's minus $50. That's like just under 10%. Well, it went up 100% from 223 to 280. Went more than 100% up. So the little bit of decline is not a big deal yet. The chances of it going back down, though, pretty substantial. Here's the monthly chart where you can just see the straight parabolic jump. Are prices of houses going up? For sure, definitely. And the only way it's going to slow down is tapering off credit. They're going to have to shorten the credit supply. Not allow banks to extend money as far as they're extending, do a bank pullback. It doesn't seem like it's going to be able to be possible yet. We've got a huge demand. We've got the largest, you've got people that are getting in their 70s and 80s, and there's a huge turnover in housing. So that was a big push in it. I specialize in probate, and there's plenty out there for sure. San Francisco, very difficult market, but the probate market, I mean, people are aging out. It's there's turnover for sure. Anyway, I figured I would show this little video, show the price of oil and gas. You can see they're definitely increasing on a weekly basis here. And there's the gasoline futures. Again, the last few months have been substantial. And then the 10-year Treasury bond, this is basically where the rates trail. So you've got from July 2020 until now, which is, still only half as high as they fell from, right? So you've got a 3.16 rate, fell down to half. That's insane. It was almost went down to zero at some point. In June they were saying that it might go down to zero. So they're really trying to jumpstart the credit, and now you're starting to see the influence of that. Shortage of workers, there's a lot of people that are basically leaving their jobs because they can't afford housing. They're trying to figure other things out, moving, all kinds of different stuff. So only time will tell, but for the moment, it looks like from now until the end of summer, definitely it's going to be a surge in price. Guys like Tom Ferry, people that are in the mortgage industry, that are telling these big market leaders all their predictions. They're thinking that's going to keep going well into 2025. So I mean, that's 3 solid years. That's I don't know where the price will go, but it doesn't seem like the price is going down anytime soon. And in our counties, San Francisco, Marin, people still have good jobs. There's still a lot of people interested in buying homes. Good tax incentives for buying homes. People are going to keep doing it. Depreciation's a thing, and you got the Augusta rule. You've got all kinds of different incentives. You can put money in your house and borrow against it, tax free. You can do HELOCs. You can do all kinds of fun things. So I think there's still incentives out there, and for the younger guys and girls that are interested in mortgages, reach out to your CPA. This might still be a great time if you get advice from anybody who's born in the 60s and 70s and lived through the 80s. 18% interest was a thing, and 18% interest it's an emergency brake. Nobody's buying anything. That's insane. So anyways, I figured I'd wrap this up with a little bit of good news, which is if you're a home seller, uh, probably looking at a pretty good market still. So if you're thinking about moving, you can probably pick up a wholesale deal, a fix and flip, something that needs some work, exit your house, downgrade in size, do some remodels, set it up nicely, still come out on top. If you're young and you want to put some sweat equity into rehab, same thing. If you want something that's in good shape and you are going to stay with it for 10 or 15 years, about to have some kids, same thing. You cannot lose with a 3% interest rate over 10 to 20 years. It's just it's so difficult for you to come out upside down on that equation because of the rate of inflation. If you're looking at 6 to 7% per year, you're already 4% ahead. So you're literally paying your debt down by doing nothing, because the rate of the interest is 3. The rate of the inflating of the dollar is at 7, 7.5, 8, whatever it's going to end up being. Your debt is being paid off by the inflation. So it's like you got in before the inflation happened, and then everything after it is benefiting you. So of course, across 20, 30 years, that's cheap. It's insanely cheap money. So anyways, guys, if you're interested in buying or selling a house, reach out. My name is Jeff, Sell It Realty, and you can find me on YouTube at Your San Francisco, and you can find me at my website, or give me a call, 707 972 4484. Let me know how I can help you out, point you in the right direction. Some good mortgage guys. If you're in probate, need some help with finding and facilitating a probate, I would love to help you out. If you are getting into stocks, I am probably the worst person to help you out. I enjoy gambling. Yeah, it's a bad habit of mine. I find it fun and intriguing, but I'm not your stock advisor. You guys have a good day, and reach out if you need anything. Thanks.